Investing wisely is akin to planting seeds in fertile soil. It requires patience, strategic thinking, and an understanding of the landscape. The world of investments is vast, encompassing various assets like real estate, stocks, gold, and more recently, Bitcoin. Each of these investment types offers unique opportunities and challenges, attracting different kinds of investors depending on their goals, risk tolerance, and financial capacity. Knowing where to start can be daunting for beginners, but understanding the basics is the first step toward mastering the art of smart investing. Real estate investment involves purchasing property to generate rental income or capital gains. It's considered one of the more stable and tangible forms of investment. In contrast, stocks represent shares in the ownership of a company and can yield returns through dividends and increases in stock prices. Meanwhile, gold has been a traditional store of value for centuries, offering a hedge against inflation and economic uncertainty. Bitcoin, a digital currency, represents a newer class of assets known as cryptocurrencies, which are notable for their volatility and potential for high returns. Each type of investment carries its own set of benefits and risks, which are influenced by economic conditions, market trends, and global events. For instance, real estate markets can fluctuate based on local economic health, while stocks are sensitive to corporate performance and broader economic indicators. Gold often sees increased demand during times of political and economic turmoil, whereas Bitcoin's value can swing wildly due to speculative trading and regulatory developments. Understanding these dynamics is crucial for any investor aiming to build a diversified and resilient investment portfolio. The following sections will explore each investment type in more detail, providing a clearer picture of how to navigate this complex landscape. Real estate investment is often celebrated for its potential to offer both stable rental yields and long-term capital appreciation. Properties, whether residential or commercial, provide a tangible asset that can serve as a hedge against inflation, as rents tend to increase with the cost of living. Moreover, real estate benefits from a variety of financing options, including mortgages, which allow investors to leverage their capital to increase potential returns. However, managing real estate requires knowledge of the market, a commitment to maintenance, and an ability to manage tenants, making it more hands-on compared to other investment types. Investing in properties also comes with its risks. Market values can decline due to economic downturns, changes in neighborhood dynamics, or oversupply. Liquidity is another issue, as selling property can be time-consuming and dependent on market conditions. Additionally, unexpected expenses such as repairs or vacancies can impact profitability. Despite these challenges, many investors find real estate rewarding, particularly when they engage actively in managing their properties and strategically selecting locations that have potential for growth and stability. For example, consider the story of Maria, who purchased a small apartment building in a growing neighborhood. By choosing a location near a university and several hospitals, she ensured a consistent demand for rentals. Over time, she was able to increase rents and, after several years, sold the property at a significant profit. Her success illustrates the importance of strategic location and market understanding in real estate investing. Real estate investment trusts, REITs, offer another avenue for investors who prefer not to directly manage properties. REITs are companies that own, operate, or finance income-producing real estate. Investors can buy shares in a REIT, which typically offers regular dividends derived from the managed properties. This provides a way to invest in real estate with less capital and without the need for direct management, broadening the accessibility of real estate investment to a wider audience. Investing in the stock market is one of the most common ways to build wealth over time. Stocks represent equity ownership in companies, and as shareholders, investors can benefit from both dividends and increases in stock prices. The stock market is dynamic, influenced by global economic conditions, corporate performance, and market sentiment. This makes it both exciting and challenging, as investors must stay informed and strategically react to market changes to optimize their returns. One of the key advantages of stock investing is the potential for significant returns. Over the long term, the stock market has historically provided higher returns than many other investment types, particularly if investors are able to buy shares at low prices and sell them during market highs. However, this potential comes with high volatility. Market fluctuations can dramatically affect the value of stocks, and without a well-thought-out investment strategy, it's easy to incur losses during downturns. For beginners, starting with well-established companies that pay regular dividends can be a safer option. These companies are generally more stable and less susceptible to large market fluctuations. Moreover, dividends provide a regular income stream, which can be reinvested to compound growth. For instance, John, a new investor, started his investment journey by purchasing shares in a leading technology firm known for its innovation and steady dividend payouts. Over the years, not only did the share price increase, but the dividends also provided him with additional funds to reinvest. Diversification is crucial in stock investing. By spreading investments across various sectors and geographic regions, investors can reduce risk and improve potential returns. Tools like mutual funds and exchange-traded funds, ETFs, can help achieve diversification without the need to buy and manage multiple individual stocks. These funds pool money from many investors to purchase a broad portfolio of stocks, making them an ideal option for those who are new to the market or prefer a more hands-off approach to investing. Section 4. Alternative investments, gold and Bitcoin. Gold has long been revered as a safe haven asset, providing a reliable store of value during times of economic uncertainty. Its intrinsic value is derived from its limited supply and its status as a universally recognized form of currency. Investing in gold can be done in several ways: purchasing physical gold, such as bars or coins, investing in gold ETFs, which track the price of gold, or buying shares in gold mining companies. Each method has its advantages, depending on the investor's objectives and risk tolerance. Bitcoin, introduced in 2009, is a relatively new player in the investment arena, but has quickly captured the attention of investors worldwide. As the first decentralized digital currency, Bitcoin operates without the oversight of banks or governments, which can make it highly attractive during times of fiat currency devaluation or political instability. However, its price is highly volatile, and it can experience significant swings within short periods. This makes Bitcoin a risky investment, suitable for those with a high tolerance for risk and a deep understanding of cryptocurrency markets. Despite their differences, both gold and Bitcoin offer unique opportunities for diversification. Gold's stability is a compelling contrast to Bitcoin's high growth potential. For example, in 2020, as global economies struggled with the pandemic, gold prices soared, providing investors with a hedge against stock market volatility. At the same time, Bitcoin reached new highs, rewarding those who were prepared to take on more risk. This demonstrates the importance of balancing a portfolio with both stable investments and those with higher return potentials. It's also worth noting that both gold and Bitcoin have their specifics when it comes to liquidity and storage. Physical gold requires secure storage and insurance, while Bitcoin requires digital wallets and a good understanding of digital security practices. These considerations are essential when deciding how much of one's portfolio to allocate to these assets. Section 5. Smart Investing. Tips for beginners. For those new to investing, the journey can seem overwhelming, but with the right approach, it can also be incredibly rewarding. The first step is education, understanding the basics of each investment type, and staying informed about market trends and economic factors that can impact investment returns. It's also crucial to assess personal financial goals and risk tolerance. This helps in crafting a balanced portfolio that aligns with individual financial needs and comfort levels. Starting small is often wise. Many investment platforms now offer the ability to purchase fractional shares or participate in investment pools with minimal initial contributions. This allows beginners to test the waters without committing substantial financial resources. As confidence and understanding grow, investment amounts can gradually increase. Additionally, leveraging technology through apps and online platforms can provide beginners with valuable tools for tracking investments and managing portfolios efficiently. Consulting with financial advisors can also provide tailored advice suited to personal financial situations. These professionals can offer insights into complex market dynamics and help develop strategies that mitigate risks while maximizing returns. For instance, the use of automated investment services, or robo-advisors, can simplify the investment process by using algorithms to manage investments based on predetermined criteria, making it easier for newcomers to maintain a well-balanced portfolio. Lastly, patience is a virtue in the investment world. Building wealth is typically a long-term process, and while there may be temptations to pursue quick gains, a steady and disciplined approach usually yields the best results. As with all forms of investing, there's no guarantee of returns, but with careful planning, a clear understanding of the markets, and a commitment to ongoing learning, the journey of investing can become a fulfilling part of one's financial life.